Hello, welcome to our Food as a Business webinar series. I am Elizabeth Canales, and today I will be talking about farm record keeping principles for farm financial management. The objectives of this webinar are to understand the importance of maintaining good records for your farm operation, to learn about the different types of farm records that you can keep and the different tools you can use to keep and analyze those records, and to learn about some recommended record-keeping practices. Record keeping is about storing, maintaining, organizing, and classifying records of the activities on your farm. And we can use different methods to do this. We can use a paper handwritten method, or we can use a computer-based method. What method we should use depends on the type of operation you have and the needs of your business. What it is important to understand is that regardless of the size of your operation, you need to keep accurate records. We will talk about some of these tools later in this presentation. Not only maintaining good records is important, it is also important to analyze those records to assess the performance of your operation and to inform decision making. Now, let's talk about why we should keep farm records. One of the main reasons why producers keep records is for tax purposes. Farmers need to report sales, expenses, and depreciation to the IRS, and keeping good records facilitates tax filing. However, tax filing is not the only use for your records. Records are also useful to demonstrate compliance with regulations or certifications. For example, you can demonstrate compliance with food safety practices on your farm, or chemical use, or compliance with organic practices. Another reason is obtaining credit. Lending institutions require detailed information about your operation, the status of other loans, expenses, expected sales, and other information useful to evaluate your operation. Record keeping is important for decision making. For example, investment decisions, whether you should expand your operation, making a capital improvement, buying equipment to replace the need for labor, or deciding whether to buy equipment or use custom hire services. In general, record keeping is useful for managing your operation better. Evaluate the performance of your operation, compare previous, planned, and actual performance, identify problems, and for short and long-term planning. Remember that farm records can be used for more than just filing taxes, and it involves more than just financial records. There are different types of records you can keep for your operation, and you need to decide what types of records to keep and the level of detail helpful to you. We will talk about some of these records in the next slides. Production records are records related to what you are producing and how you are producing it. For example, what you planted on each field, when you planted it, what your inputs are, what chemicals you're applying, when did you harvest, what was the yield and quality of your harvest. When you are farming, you conduct different experiments with new varieties, products, or new practices. And it is important to take notes of the things that worked and the things that did not work. Marketing records refers to records about your sales, where you sold your product, when, how much you sold, and at what price. These records will help you keep track of the revenue generated from all of your crops. And if you're selling through different market outlets, it can help you assess the profitability of each of the market outlets you're working with and the demand of your product at each of these markets. Financial records relate primarily to financial and money transactions on the farm. For example, income from sales, operating expenses, equipment or input purchases, loan balances, assets, and asset depreciation. We need these records to develop our financial statements. We will talk about financial statements and record analysis later during this presentation. And there are other records you can keep. For example, records about your equipment and maintenance schedule, employees and labor use on a specific crops or tasks, records of food safety practices used on your farm. There are other records you can keep. You need to identify what records are useful for you. As previously mentioned, farm records can be used to monitor farm performance, so it is important to evaluate our farm records periodically. Farm records are used to construct financial statements like balance sheets, cash flows, and income statements, and also other tools like whole farm budgets or enterprise budgets. I'm going to briefly talk about these statements during the next slides. A budget is a financial plan or management tool that helps us plan for the expected sales and expected expenses from our crops and farm operation. Having good records is key to developing good budgets, as our records inform what we expect to make and spend in the future. In order to develop our budgets, we need to classify our cost. We have direct or variable expenses and indirect or fixed expenses. Direct expenses are those that are directly related to the production of your crops or products. In crop farming, this could be soil preparation, seeds, fertilizer and pesticides, fuel, labor, and packaging, among others. If you also have a cottage feed operation, direct expenses could be things like raw materials used during production, for example, fruits and sugar, packaging and labeling materials, and labor. On the other hand, indirect, fixed, or overhead expenses are expenses not directly related to the production of your crops or products. These include ownership cost and the cost of running your farm operation, even when production is zero, and it includes mortgage, rent, insurance, taxes, interest expenses, marketing expenses, for example, if you pay marketing fees, and depreciation on equipment, among others. If you do not currently have a budget for your crops, you could use Mississippi State University's planning budgets as a reference. You can visit the website highlighted here and click on the budget you need. Remember that you need to adjust the budgets. Based on the conditions of your operation, you need to modify it with your farm's information. In this example, I had budgets for 3 crops: cucumbers, cabbage, and broccoli. The records required to build a budget are expected yields and prices, and expected expenses, both direct expenses and indirect expenses. Parts of your total fixed or overhead expenses can be allocated to your different enterprises or your different crops. You can build a budget for your whole farm or for your different enterprises. Enterprises can be each of your crops or activities, for example, livestock, cottage foods, or crops. And if you have crops, it can be the different crops you produce. In my previous example, I had a budget for each of 3 crops: cucumber, cabbage, and broccoli. Enterprise budgets help you evaluate the resources allocated to each crops and the profitability of each of these crops. Analyzing this will help you determine the best crop mix. We covered planning budgets. Now we're going to talk about financial statements. The first one is the balance sheet, and it shows you the net worth of the farm on a specific date. It tells you what your assets are against the amount of money you owe on those assets. In this slide, I am showing a very simple example of a balance sheet. Generally, you will have more asset and liability categories and more details. But really what it shows you is the assets you have, the liabilities you have, and the net worth of your farm. Usually lenders are very interested in this statement because they want to know your financial standing. The records required to build the statement are asset values, money on check accounts, cash, inventories, and all the liabilities you have, for example, loan balances and payables to suppliers. The income statement is also known as the profit and loss statement, and it lists all income and the expenses from the farm during the period of analysis. This statement helps us determine net income and the profit margin of our operation. To build a statement, we need records of all of our sales, production expenses, and the expenses incurred in operating the farm or overhead expenses. The cash flow statement, on the other hand, helps us project cash inflows and outflows, and it helps us identify the times of cash needs to pay our bills, to buy inputs, and to pay loans. As the example in this slide shows, we can have monthly cash flows and we can also have yearly cash flow. The idea is to help us identify when we will have those cash needs. Now we're going to switch gears a little bit and talk about record keeping methods. There are different record keeping systems you can choose from, and it all depends on the type and size of the operation you have and your information and analysis needs. There are paper methods and computer-based methods like Excel, Quicken, and QuickBooks, or specialized softwares. Keeping in mind that software programs are more accurate and facilitate reporting and analysis for decision making. We are not going to cover specialized software in this presentation, but if you have any questions, please let us know or contact your local extension office. The first method is the paper or handwritten method. This is a very simple and very common approach, and it consists of storing receipts and other information and keeping track of expenses and sales transactions on a ledger or book. The disadvantage of this method is that it's more prone to error, and you have to make your own calculations by hand, so it really limits the level of analysis you make. Some farmers work with accounting services to do their taxes and to develop business statements with the information they collect. Just saving your receipts in a shoebox without recording your transactions is really not the best practice. Now, a step between a paper method and using a software is using an Excel spreadsheet. You can set up a page for each of the records you want to maintain, and even if you use a software, you could complement or keep production records using Excel if your software does not have that capability. You can set up your own forms or adapt other forms that are available for free online. For example, the Southern Sustainable Agriculture Working Group has different Excel templates for record keeping that you can adapt to your farm. If you're interested in checking them out, here is the link to their website. We are going to mention a couple of commercial record-keeping programs, and this does not mean that I am endorsing or favoring them. They are just commonly used options by small businesses. A very commonly used tool by small businesses and accountants is QuickBooks. It uses a double entry accounting system, which means that each transaction impacts the model in more than one way. For example, an equipment purchase not only increases my assets, but it also decreases my checking account or increases my liabilities. If you are not familiar with accounting, then you need to familiarize yourself with some accounting terms before using this tool. Their chart of accounts can be modified to reflect your type of operation, and you can track expenses, income, liabilities, and owner's equity. It also has other capabilities like invoicing, and for a fee, you can have access to the payroll tools. It also allows you to create financial reports like balance sheets, profit and loss statements, and cash flows, among others. And you can also share all this information with your accountant. The cost is relatively low. You can buy the desktop version for approximately $200 or pay the online yearly subscription. If you go to their website, you can see the different products, features they offer, and the pricing. If you're interested, you can check it out. Just make sure that this is the right tool for you. Remember that you will need some time to learn how to use these tools. Quicken is another tool commonly used in the farm community. Quicken is simpler than QuickBooks in that it's a single entry system that helps you keep track of income and expenses. It also allows you to keep personal and farm records. If you're not familiar with accounting, this is a good place to start. If you later decide that you need other features like invoicing, tracking accounts payables and receivables, or equity, then you could use QuickBooks or a specialized software. But this is really a simple tool and a good starting point for a family operation. The cost of Quicken is between $35 to $90 per year based on the version and the features offered. The most popular version costs around $45 a year. It is important to identify a record-keeping method that works well for your operation. Before deciding what method to use, analyze the value that the program or tool will bring to your operation, what the cost is, and what you're wanting to get out of it. First, identify your needs and what will be helpful to you. Once you have a record-keeping system in place, make it a habit to record each transaction regularly, the same day if possible, to avoid losing documentation or forgetting important details about each transaction. It is also a good practice to reconcile your bank statements with your checkbook and the records in your record-keeping system. And remember to have a separate check account for your business. This is really important. Once you have good records, create your financial statements and analyze them to inform your decisions. Remember to use your records for more than just taxes. Thank you for your time. I hope you found this information useful. If you have any questions, please let us know. This webinar was supported by the Southern Extension Risk Management Education Center through a USDA NIFA grant. Thank you.